In this video I am going to tell you 5 index funds to buy now that have the potential to multiply your money by 5. The really interesting thing about index funds is that it is a totally passive investment. You just have to buy them, wait, and make money. It is a really simple investment. It has nothing to do with other investments such as real estate where you really have to invest a lot of time to visit flats, to go to the notary, to go to the bank, get taxes to pay, go to the town hall, register it, look for a tenant. It is an investment in which you will not have to invest so much time, and you can also start investing in index funds with only $100. In the end, when you invest in index funds, you are investing in a lot of companies. All those companies work very hard from Monday to Friday to make money, and if those companies make money, their value increases in the stock market, therefore you also make money. To prepare this video I have had to invest a lot of time to find out which are the best index funds, therefore I have decided that this is a paid video. In order to access the content of this video, you simply have to leave a like. Once you have done so, let's go with the video. Before moving on to the content of the video, I want to make it clear that I am not an expert in index funds, and I am not an expert in investments, far from it. I am simply a person who is very interested in the world of investments, and after having informed myself for a long time, I have come to the conclusion, and according to my personal opinion, index funds are one of the most profitable and safest investments. In this video I am going to tell you 5 index funds that for me are really very interesting, but this is still a personal opinion. Do not invest in any of these index funds simply because I have mentioned them. Before investing in anything, it is important that you inform yourself very well. Before going on to tell you about these 5 index funds, I am going to explain to you very quickly what exactly an index fund is, and how it differs from an ETF. To understand what exactly an index fund is, we have to understand what a traditional investment fund is. Basically, many people are going to put their money in this fund, and there is going to be a manager, there is going to be a person, an expert, who is going to be in charge of investing that money. That person will be in charge of buying shares and selling shares with the aim of earning money. The problem with this type of fund is that they usually have quite high commissions, and it is totally understandable. Why do they charge such high commissions? Basically because with those commissions they need to pay these managers and these people who are going to manage this investment fund. These types of investment funds are the funds that the bank will try to sell you. Why is the bank always going to try to sell you a fund like this and not an index fund? Basically because a fund like this charges commissions, and that is how the bank is going to make money. Something to understand about the fees charged by traditional funds is that they will charge you a fee based on the money invested. They will not charge you a commission based on the money they have made you earn, but they will charge you 1%, 2%, 3% based on all your money, whether you win money or lose money. On the other hand, an index fund is also an investment fund, but in this case there is no manager who decides which shares to buy or which shares to sell. Basically, an index fund is going to be indexed, as its name indicates, an index. Imagine a fund indexed to the IBEX 35, because the only thing that this indexed fund is going to do is automatically buy the 35 largest companies in Spain. There are funds indexed to cocoa, although it would be like the IBEX 35, but from France. There are funds indexed to the SP 500, which is the list of the 500 largest companies in the United States. This type of investment funds hardly charge commissions. Why do they hardly charge commissions? Because basically they don't need money at all, because it's all automatic. There is no one person that you have to pay to decide which stocks to buy or which stocks to sell, but the really interesting thing about index funds is not that they charge very few commissions, but the really interesting thing about index funds is that historically, in the vast majority of cases, an index fund is more profitable than an actively managed fund or a traditional fund. Once you have understood the difference between a traditional investment fund and an index fund, let's see what the difference is between an index fund and an ETF. Actually, the differences between an index fund and an ETF are very few. In the case of an index fund, it is an asset whose value is updated once a day because the price of that asset changes, while in the case of an ETF they are treated as if they were a stock, therefore it is constantly quoting, and it is constantly raising the price, lowering the price, and you can see it in real time on your mobile or on your computer. But the main difference is due to the tax issue. In the case of investment funds, they have something interesting that allows you to change from one investment fund to another without the need to sell it. You don't have to sell one fund and then buy the other, but what you can do is simply swap one for the other. In this case, what this allows you is not to pay taxes. Imagine that you buy a fund, you earn €1,000, and instead of having to sell it and pay taxes on these €1,000 to buy the other. Simply because you earn €1,000, and what you have here you change to another investment fund, and you do not have to pay taxes. In the case of ETFs you cannot do this. If you buy an ETF and earn money and later want to buy another one, you will have to sell it and pay taxes and have to buy another one. So with that said, now I am going to tell you the top 5 index funds. The first index fund is the index fund that I personally invest in, and this index fund is the VT. As you can see, it's a Vanguard index fund, and basically this is a world economy index fund. This index fund has the top 9 largest companies in the world. Therefore, by investing here you are investing in companies from the United States, Europe, Latin America, from all over the world. For those who do not know, Vanguard is the manager of this index fund. Basically, Vanguard is the company dedicated to managing these index funds. Vanguard is a company that has been operating for many years and has a very good reputation internationally, but there are really a lot of managers that offer exactly the same index fund. Being an index fund, it is very simple and any manager can offer the same service. Something super important that we have to look at is the expense ratio, which is basically the commission that this index fund charges. As you will see, this index fund charges a 0.07% commission on the money you have invested. Therefore, to give an example, if you invest €1,000, they would be charging 70 cents a year, while a traditional fund would be charging you more or less about €2. On your page we really have all the information about the fund. Well, returns appear, how this investment fund is made up, etc. In the portfolio part, it really appears with all kinds of details that this investment fund includes, because when we are investing in a fund we are really investing in what has the bottom. It appears to us what it includes today, and includes 9,389 shares. The largest holding that basically are the companies in which the fund has invested the most, and in this case we can see that it is Apple, Microsoft, Alphabet, Google, Amazon, Tesla. Even if we click on portfolio holdings we can really see all the companies that this fund includes. We can see it by percentage of the fund. For example, Apple represents 3.43% of the fund. Apple is the biggest company in the whole world. We can filter by being live sport market. I don't know how much money is invested here, we really have it all, and even if we keep going down we can see the percentage of investment. In this case we can see that the United States is a 59%, Japan 6%. Well, we can see all this, and what is really interesting about index funds in this case, in this index fund to the world, the top 9,000 largest companies in the world, in this case we can see that the United States is 59% of this investment fund. But if at some point the United States ceases to be so important, then this percentage will simply go down, because it will go down. Basically because there will be companies from the United States that will automatically leave the top 9,000 and other companies from other countries will enter, such as China, as it can being an Indian. Therefore, to earn money with this fund, all you need is for the world economy to do well. It doesn't matter to you if the country you lead is the United States, or if it's China. What interests you in order to earn money is simply that the world economy is doing well. The good thing about this index fund is that in the end we are investing in thousands of companies, and within these thousands of companies there are some companies that distribute dividends. For those who do not know what dividends are, basically when a company distributes among its shareholders a percentage of the money it has earned. For example, Apple distributes dividends, Coca-Cola distributes dividends, many of these companies distribute dividends, and in this case, as we have shares in these companies, we also receive dividends. In the distribution section, we see the last times that this fund has distributed dividends. It appears to us that the last time was relatively recently. They paid it on the 24th of this month, and they paid $25 for each of the shares of this ETF. That each of the shares of this ETF costs today $101. It is an extra income without having to do literally anything, and we come to the price and performance part. We can see what the profitability of this index fund has been in recent years, but something that I want to make very clear is that past returns do not guarantee future returns, but it is important and can give us an idea. We can see the return not for 1 year, 3 years, 5 years, 10 years. This is the annualized return. It does not mean that in 10 years it has given 10% in 10 years, but if we analyze these 10 years it has given 10% annually. The return since this index fund was opened is 9.47%. The second index fund is the VU. This index fund is a fund that is indexed to the S&P 500. The S&P 500 is the American index that has the 500 largest companies in the United States. Basically, it is like the IBEX 35 of Spain, which are the top 35 largest companies in Spain. Well, in the United States they have the S&P 500, which are the 500 largest companies in the United States. This is a really very famous index that I am sure you are familiar with if you are interested in the subject of personal finance. On your page we have all the information. First of all, what is the commission for having a fund? We can see that it is 0.03%. It is even lower than that of the VT. If we come here to the part of the portfolio, as I have mentioned, in this case there are simply companies from the United States, therefore they do not tell us what percentage there is from the United States or from another country, but rather that it is 100% United States. What it does tell us that is quite interesting is in which sectors of activity our money is invested. In this case, we can see that the majority, 28%, is technology, but there are also the healthcare industries, which would be health, finance, electricity. Well, we can see this real and we can see all sectors of activity. Then the holdings also appear in this case because Apple, Microsoft, Alphabet. If we come to the performance part, which is basically profitability, we have all the information. We can see that this last year it has given 16.21%, which is not bad at all. The last 10 years it has given 14.54%, and then since the creation of this index fund that was created in 2010, it has given 15.08% per year. This is from the moment this index fund was created, but the S&P 500, being an index that has been around for a lot of years, we can know exactly what the return has been for the last 200 years, which is more or less 10% or 18% if we count inflation. In the case of this index fund there are also companies that distribute dividends, therefore we go to the distribution area and the last dividends they have distributed appear, and how much is the dividend? In this case, the dividend has been $137, but of course, in the end, the important thing is to see the percentage based on the price of each of these shares. Two important things. One, really, the price of this does not matter in the end. If the stock rises 10%, it does not matter if it costs $400 or $100. You have earned 10%, and the second is that the vast majority of brokers allow you to buy a piece of an ETF. For example, you can buy $50 of this ETF and therefore they will not give you 100% of the action, but they will give you a percentage, but it is still interesting. The next index fund is the VTSAX, which is basically an index fund that is indexed to the entire American economy. In the case of this fund, we are investing in the top 4,000 largest companies in the entire United States. Basically, what this fund allows us is to be able to invest in many more companies and thus further diversify our capital. The commissions of this fund are a bit higher than the previous one, it is 0.04%, but I tell you that it is very, very low, especially if we compare it with other investment funds. The yields, then, are 11%, 17%, 14%, and since 2000, 8%, which is really good. In the area of dividend distributions it appears in this case that the last one was 34 cents, it has had other 41 cents 34 32 well here we have all the information. The following index fund is an index fund that I really find super interesting, and is completely different from the ones we have seen before. It is an index fund that instead of buying shares, what it does is buy REITs, which is a REIT, and to explain it in a super simple way, basically a REIT is a company that is dedicated to real estate. There are REITs of all kinds. There are REITs that have shopping centers that what they do is that they build a shopping center, and then they rent all the premises of the shopping center. There is another REIT that what they do is that they buy warehouses and rent them to companies. There are other REITs that what they do is that they buy premises and rent them to companies. There really are REITs that do all sorts of things, but they always have to do with real estate. So REITs are a very interesting way to invest in real estate without having to go to the bank to ask for a loan to find a tenant. In addition, what a REIT index fund allows us is to be able to invest in simply an index fund, and that index fund has a lot of REITs, therefore it allows us to diversify our investment. In this case I am going to present you two REIT index funds, but I am going to present them to you a bit as a pack, because basically they are very similar. In this case we have the VNQ, which are the most important REITs in the United States, and then over here we have the VNQ, which are the most important international REITs, which are basically from all countries except the United States. In the portfolio area from the United States we can see that it has 166 REITs, and if we go to the international we can see that they have 699 REITs, and it is normal because this is a country, and this is all the rest of the countries. In the VNQ we can see that they also have it well diversified, because they have some residential, retail, services, industrial, hotels. Well, we can see everything. Here the list of REITs would always appear. For example, we look for comfort rating, which is one of the REITs. We simply look for it on its own website, and we enter, and the portfolio appears, basically what this company has. If we go to the tweet type composition itself, it appears to us that the vast majority of properties have them in retail, which is next because it would be the stores, and then it has a percentage of industrial. The last fund, but not the least important, is the VO. This fund seems quite interesting to me because by investing in this fund you are investing in some countries that are still called emerging markets, but the reality is that today they should no longer be called emerging markets because they really are not. In the information of this fund we can see that the commissions are 0.08%. It clearly appears that this fund has a high risk. Obviously it is not the same risk to invest in the United States, the top one economy in the world, and an economy really established, than investing in emerging markets such as China, India, or Brazil. Then over here we can see the graph, and we can see a much more important volatility than the other funds that we have seen. In the portfolio part we can see the companies. We see for example Taiwan Semiconductors, Alibaba, Vale SA, China Construction. We can see companies from countries that are considered emerging markets such as Taiwan, as we can see Alibaba, which is from China, as we can see China again, we can see Brazil. And here it appears to us as it is divided into countries. Taiwan, India, Brazil, South Africa, Saudi Arabia, Thailand, Mexico, Indonesia, Philippines, Qatar. You can see a lot of countries that, as I say, are considered emerging markets, but the reality is that they are no longer. In the performance area we can see that in the last year they have given a negative return, and in the last 3 years they have given 7%, and in the last 5 10.3%, and since the creation in 2005 6.45%. It is not a very high return if we compare it with the other index funds, but this fund is a bit of a bet in saying, hey, I think that these countries in the next 10, 15 or 20 years are going to be countries that are going to have real growth. Then if we go to the dividend distribution part we can see all its dividends here. Once we have seen the top 5 index funds, I would like to conclude this video by saying that if we simply base ourselves on what has happened historically, the most interesting thing is to invest in the American economy. How do we invest in the American economy? Well, with 2 of the index funds that we have seen, either the SP 500 or the VTSX, we would be investing in the entire American economy. The reality is that historically the American economy has been the most profitable because the United States has not stopped growing. As nobody knows what will happen in the next 100 years, and we don't know if the United States will continue to be the #1 power or if another country will come. Personally, what I do is invest in the whole world. Therefore I don't care if the United States continues to be in the top 1 or if China becomes the top 1. I don't care because I invest all over the world. To invest in the whole world, what I do is simply invest in the VT. This is my opinion, and since I invest, it does not mean that it is the correct way. I hope that this video has been useful to you. If you liked it, do not hesitate to leave a good like, which is something that does not cost you anything and helps me a lot. Don't hesitate to subscribe so you don't miss other videos like these. So nothing guys, I'm Mega Investitor and see you in the next video. Bye.